welcome to the massive open online course on the paper Money and Financial Markets. Financial crisis, as we say, is a situation when multiple financial markets or financial assets cease to function. There is a collapse in the entire financial system of an economy, and thereby the crisis can be exhibited as a non-systemic crisis, where only one or few markets are mainly responsible and the transmission effects occurs across the globe, and thereby the crisis becomes magnified and thereby it cripples the entire functioning of the financial system. A systemic crisis has been there in the world for a longer period of time, and which have the recent examples of financial meltdown of 2008-9 or the Great Depression of 1930s. Any analysis of a crisis takes care of the causes. So by the causes of the crisis, we can enumerate some of the micro and the macro factors which are responsible. The factors are namely as increase in the uncertainty, increase in the level of the interest rates, government fiscal problems, balance sheet deterioration, banking problems, and panics. So we will take up the factors one by one. Firstly, with reference to the causes of the crisis, first we refer to increase in uncertainty. Increase in uncertainty occurs when the future plans cannot be done or the investment decisions are shattered. So when the companies cannot plan for the future, and when the interest actually what have been discussed by the Federal Reserve keep on changing, then the investors cannot have their constant confidence, they lack the confidence, the corporate earnings decline, and thereby the financial investors fail to play in it. In case of the increase in uncertainty, also we see that the people are having excess of liquidity in them. That is what we say liquidity trap or excessive cash in the hands. And thereby more of cash results to high level of inflation or hyperinflation, which also reduces aggregate economic activity. So increase in uncertainty is due to the rise in the interest rate. Also it refers to excessive cash in hands, and thereby the country is more towards price instability. The second factor is categorically increase in the interest rate. So higher interest rate makes the cost of borrowing to rise, thereby it demotivates the investors, and thereby the investment crowding out effect takes place. So this also actually demotivates the private investors, discourages the borrowers, and so the investment channel becomes narrowed or skewed. The third factor is responsible for the crisis, which refers as government fiscal problems. By government fiscal problems, we mean that the government has a tendency to adopt expansionary fiscal policy. That means they want to expand more by taking care of the revenue generation, or by lowering the tax, or by the expenditure methods. So more they borrow in order to cover up the deficit, the harder it is difficult for them to repay the debts, and thereby the defaulters of the loans takes place. This also has an effect on the balance sheet of the firms at micro level, and also at the macro level on the aggregate functioning of the economy. So governments that expand more than they take via taxes, the more they borrow, the harder it is for them to deliver the service, and thereby the loan obligations are on the rise. The balance sheet of the firms gets affected, and thereby investment in the government bonds takes place, whereby the debt obligations keep on rising. This is also further accentuated by exchange rate crisis in a globalized economy, because by the exchange rate it means depreciation of the domestic currency makes the country to be more dependent upon the exports, but the cost of the imports are always on the rise. The second factor that comes up along with the government fiscal problems is the deterioration of the balance sheet. So when a firm's balance sheet deteriorates, it means that the net worth of the asset keeps on falling, the non-performing assets are on the rise, or the liabilities are on the rise, and thereby the stock market participants becomes highly confused or highly degenerated. This type of degeneration of the stock market participants actually results to loss in the confidence in the stock market, and where also the lack of complete information comes up. That is, asymmetric information emerges. Moreover, the company also engages to take more of riskier activities due to the deterioration in the balance sheet, and the moral hazard increases because the selection of the investors doesn't go in the same way. Adverse selection takes place, and which makes the market to be highly risky and highly vulnerable. Another problem which is also contributing to this crisis is the banking problems and the panics. Whenever we see that the banks are lending each other, or when the banks are lending to firms or the investors, in most of the cases the smaller banks are exposed to high level of bankruptcy or bank fail. And so there is a question on the solvency of the credits. Moreover, the failure of the few banks may induce the holders of the banks' monetary liabilities to go on, and thereby they run out of the funds. And whether the bank is good or not, institutions come to know within a few days, because that is how the bankruptcy comes in and solvency issues arise. So looking into the concept of the financial crisis and the causes for it, the following questions can emerge. What is meant by financial crisis? A financial crisis occurs when multiple financial markets or financial intermediaries cease functioning or function only erratically and inefficiently. So by erratically means it follows an irregular pattern in its balance sheet or in its financial variables, and inefficiently because it is incurring losses or it is also near to the closure. The second question comes up from this discussion is, what are the causes of the financial crisis? So we can enumerate the causes like increase in uncertainty, increase in interest rate, the government fiscal problems, balance sheet deterioration, banking problems, and the panics. Because this is actually our interconnected factors which are linked with each other, and they end up in the verge of a huge crisis. Now, in order to understand the mechanism or the dynamics of the crisis, we introduce the concept of asset bubble. That is what has happened in the financial meltdown of 2008-9. So when we talk about the term asset bubble, it means that increase in the value of some assets like bonds, commodities like cotton, gold, oil, tulips, or equities or real estate above their rational or fundamental level. So an asset bubble is just like a vacuum where the price of the financial assets keep on rising without any limits, making the system to be expansionary without any proper monitoring. So some combination of low interest rates, which is one of the most attractive indicator for attracting the investors at the time of originating any kind of bubble, new technology which is also cost reducing, unprecedented increase in demand for the asset. This also takes care of when the real estate demand rises and the demand has no limits, and typically all these factors contribute to create the bubbles in the globe or bubbles in the economy. So there are some financial panics which are the reflections of this asset bubble. The major financial panic occurs when the leveraged financial intermediaries must sell assets quickly in order to meet the lender's calls. So when the asset bubble is basically expanding, then a time occurs when it bursts out. So before bursting out, the indication is that the borrowers want to sell off their assets, or the assets are being sold at whatever prices they are getting before it is exposed to the bursting. That is actually taking place because of the financial panics. Secondly, the lenders call loans or ask for repayment, which is basically the time when the debt obligations are on the rise and when there is a pressure to repay the debts, when interest rate increase or the value of the collateral pledged to repay the loan sinks below the amount borrower owes. That means the repayment is compulsory, and at that point of time, sale of the assets or sale of the financial intermediaries takes place at a faster pace. Thirdly, the financial panic also refers to calls are a normal part of everyday business, but during a panic, they all come together due to some shock, bursting of an asset bubble. That means asset bubbles are about to burst, which means that all the assets which are being purchased at a low prices, now they are being sold off because the market becomes highly expansionary without any proper regulation of any institution or government. So we have more reflections of the financial bubble, like bubbles are bound to die, but nobody knows in advances they will do so. Because the crisis cannot be predicted or estimated, one fine morning the bubble bursts out. A burst is somewhat triggered by an obvious shock, like a natural catastrophe or a failure of an important company. That means if any company fails, for example, Lehman Brothers failed during the 2008-9 US financial crisis, just like that, any failure of any company also is an indication that the bubble has started bursting, or sometimes it can be done without any indicated event. So during a panic, everybody must sell and few cannot want to buy, because this is also triggering additional calls, but the investors' confidence consistently is on the decline. So invariably, some other investors can take care of the highly leveraged ones. One can sell the assets which are very attractive, one can wait for the final call, but in most of the cases, banks and the other lenders begin to suffer defaults. That is how the rate of the default is on the rise, and that is how the bankruptcy comes up, which makes the lenders to wonder if they still said the credit worthy. So one of the most important phenomena which has been continuingly responsible for all these events is none other than asymmetric information and uncertainty, which makes the lenders to restrict credit. Because this information coordination is always incomplete between the borrower and the lender. So taking care of this financial asset bubble and the financial panics, we can take up the question as, what are the reflections of the financial panics? So one of the major reflection is burst of the asset bubble, which is actually expanding without limits, repayment of the loans, which is actually making them to defaulters, lack of the confidence among the investors, which has already started place at the beginning of the bubble, possibility of defaults, asymmetric information, one of the major cause, and market uncertainty because of the fluctuations in the stock market and also in the world indicators. In order to combat the crisis or address the crisis, there is a role of a central bank. That is an institutional responsibility to take care of the crisis management. So firstly, we take care of the financial panics and how central bank takes care of it. Financial panics and the deleveraging that often occur after them can create an havoc on the real economy by decreasing the volume of loans, insurance contracts, and other beneficial products. That means the financial system will come to a collapse with the huge level of liquidity crunch, with less assets being floating in the market, and a huge level of investors' confidence. So in this scenario, the firms can reduce the employment and the output, thereby adding to unemployment problem, and thereby the aggregate demand also becomes deficient. This is one of the major cause of majority of the crises across the world. So lenders of the last resort, which is none other than the central bank, can make an intervention to stop the panic by deleveraging, by adding liquidity to the financial system. That is how the adoption of contractionary monetary policy, which was earlier done, now they will go for expansionary monetary policy. They will inject the money supply into the economy and thereby attempt to restore the investors' confidence, because the components of aggregate demand are on the fall and deficiency of the demand is the major cause which is responsible for the crisis. Moreover, the central bank can increase the money supply by the adoption of expansionary monetary policy, make the interest rate to be more attractive for the borrowers, the loans to be worthy for the borrowers, and also introduce different sources of financing. Central bank also make an attempt to restore the investors' confidence by improving the health of the economy or the financial system so that investors become really beneficial. So keeping in mind this, the central bank also can take care of the European Central Bank, Federal Reserve, because they can take loans from their higher authority institutions. Even IMF can also extend its support to actually manage the crisis in terms of the fund and credit management. So looking into the role of the central bank, we can have the following question. What is the role of the central bank to address the financial panics? Two separate roles can be taken care of. Firstly, they can go by giving more credit to the financial system, that is releasing more money supply, printing more paper notes. And secondly, they can adopt the expansionary monetary policy by reducing different rate of policy rates, making the loans to be awarded to the borrowers, and thereby also introduce to all different varieties of financing. That is how the central bank can take an initiative. To combat the crisis, the central bank has another alternative, that is to bail out and also to explain its consequences. So by the bailouts, the central bank actually provides liquidity, as it has been already mentioned, to combat the crisis in the times of liquidity crunch, also to make the loans to be more comfortable, and also it takes an attempt to boost confidence among the investors by lowering the rate of interest or the cost of borrowing. They also make loans to solvent institutions facing temporary solvency problems. These are basically being done on an emergency basis, on an accommodative policy, and which are actually considered to be for those institutions where bankruptcy is not inevitable. That means they are considered to be loss-making, but they can come up from their existing situation. Bailouts actually are a mechanism which is done by the introduction of the government and coordination with the central bank to restore the losses suffered by one or more economic agents, usually with the taxpayer money. That means the taxpayer money or the government's revenue is actually being taken care of in order to raise the funding, and that is how the amalgamation of the fiscal and the monetary system takes place. Bailouts are often controversial because they can appear to be unfair, because in some of the cases it is actually hurting the ethics of taking care of the taxpayers' money to combat the crisis, but they also increase the moral hazard or the risk by taking care of the entities which are expected to be bailed off if they encounter difficulties. Because in most of the cases the government is under deficit, and under that situation taking out the taxpayers' money to combat the financial crisis may be highly costly for any economy. So that's why bailouts are considered to be more and more controversial in terms of the political words. But in order to discuss about the bailouts, another reflection comes in that if the lender of the last resort cannot stop the formation of a negative bubble, or bailouts can be an effective way of mitigating the further declines in economic activity. That means if the bubble has to come up and bursting of the asset bubble takes place, that the central bank has nothing much to do, then it has to get the responsibility of the fiscal system or the government to take the policy of bailout. That is how by taking out of the money or by releasing the money from the fiscal funds, crisis can be managed. The bailouts can act as an effective channel to mitigate the reflections of the crisis, for example, gaining the confidence or reducing the financial panics or even taking care of the collapsing financial system. The central bank looks into the bailout mechanism effectively because central bank and the government of India actually works in a better coordination, and that is what is called in the theory as accommodative monetary policy. So taking care of the reflections of the bailouts, we have the following question. What are the reflections of the bailouts? Firstly, bailouts actually restored the losses which are suffered by the economic agents, and usually this is done by the taxpayers' money, that is in terms of the government's revenue. The bailouts can act as an effective channel to mitigate the reflections of the crisis. That is another important contribution of this bailout. Now we are taking care of the most important crisis of 2008, which had been the realistic crisis of Indian economy has been affected, and it has come up in the US economy, and it has actually penetrated into the world economies through different transmission channels, namely the stock market, the investors market, and as well as the foreign direct investment channels. The most recent financial crisis, which began in 2007 as a non-systemic crisis linked to subprime mortgages or risky loans to the homemakers. because it is the real estate sector which has been actually being the continuous prime effect of the crisis or epicenter of the crisis, because the housing loans were available at a low interest rate which has expanded and which has been contributed to the creation of an asset bubble in the real estate market. In 2008, the failure of the several major financial services companies turned into a more severe systemic crisis in the United States since the Great Depression. The Great Depression of 1930s was due to the fall in the aggregate demand, but after that, of a similar magnitude, this crisis had come up in the year 2008-9, which has become more and more systemic because of the expandatory monetary system. The troubles began with a major housing asset bubble. Mortgages also became easier to obtain, and at the same time it was felt that selling off these assets or houses would have been a way out from the crisis, but later on it added to huge liquidity, making the macroeconomic indicators to fail, interest rate to go up, the inflation rate to go up, and accordingly the substantial percentage of the home's value as down payment also has been come up from the borrowers. That means the borrowers had been largely responsible for this, and at the end of the day, the collapse of the financial system took place. So in this particular discussion, we can sum up as by the concept of the financial crisis, which is basically collapsing of the multiple markets together, leading to the cease in the functioning of the financial system of a nation, and which is also transmitting across the globe. Causes of the crisis can be due to uncertainty, hike in the interest rate, and many other factors which are responsible. For example, boost in the confidence of the investors, which is going down. Concept of asset bubble, which is how the bubble gets started. The shape of the bubble is expanding, and thereby the major participants are mainly because of the huge number of borrowers and the lenders in the system. Financial panics, which are reflected by the fall in the investors' confidence, and also it has been reflected by the increase in the cost of the borrowing, and also in majority of the cases bankruptcy takes place. Explanation of the bailouts, which is taking care of the taxpayers' money to recover the crisis, and where the central bank basically injects the money and thereby the crisis comes to an end. And one of the noted example of the crisis very recently had been the 2008 financial crisis, which is due to the housing asset bubble which has taken place, and thereby the crisis has become twofold or manifold in the recent times. Thank you.